Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 157th podcast, 167th videocast for the week ending December 29th, 2022. We'll cover the media real quick and then get right down to it. This is our last videocast for the year. It went by really quickly. So first and foremost, I would like to thank Kat Myers. I'd like to thank Kelly O'Grady and Liz Clayman for having me on Fox Business, the Clayman Countdown this week to discuss the general economy outlook and Cooper Standard, which is now up 56% since inception. And for those of you who have been with us on the podcast, kudos to you. And I think that's the beginning of good things to come. So you can check out that full interview here with Kelly O'Grady. Next, I'd like to thank DJ Durkin and Rebecca Mezzistrano for having me on thestreet.com to do an interview and outlook. A lot of really good detailed info here. You want to check that out. I'd like to thank Amruta Kandekar and Ankika Biswas for having me in their Reuters article this week. I'd like to thank Alexandra Steigrad for having me in the New York Post, one of my favorite paper. I'll admit it. My favorite business paper is Barron's, but that's my favorite paper. I enjoy it. I'd like to thank Akash Sriram for including me in his article on Reuters as well. And I'd like to thank Ann Berry and Michael Teak for having me on public.com last Friday. This was really good about emerging markets in China, so you want to check that out. And finally, Amruta Kandekar for having me on an article on Reuters this week as well. Very grateful for that. Let's get right down to it here. Okay, we're going to go through first off, we're going to go through some sector stuff. And we're also... So I want to go through some sectors just so you can see what's oversold here, because a lot of selling in December with tax law selling more than normal because of the year, worst year since 2008. So it created a lot of opportunity here, but in certain sectors. So communication services, no one wants to touch it with the 10-foot pole. Historically, you can see the odds favor buying at these levels. Same with the NASDAQ and tech. No one wants, you can't give them away. Same thing, consumer discretionary. We're going to cover that towards the end, but this is going to be one of the highest earning sectors next year. And again, no one wants it, so you can find some opportunities in there. What are people, clamoring for? They're clamoring for healthcare because it's defensives. It's already had its run. They're clamoring for industrial stocks. It's already had its run. Here's tech at levels where you want to be a buyer. Materials, they're rolling over. They've already had their run in the short term. NASDAQ, again, near buy levels. So you see what everyone's pitching on TV, get into energy, get into materials, get into industrials. It's rear view mirror looking. I think forward looking as rates stop going up. I think there's going to be a bid for cash generative tech, consumer discretionary, communication services. But again, I do think that emerging markets are going to outperform developed markets on a relative basis. Here again, staples already had their run. Everyone's pushing staples and defensives right now. I think that's the exact wrong move. Transports are bottoming, and utilities got defensive, etc. So the other thing I want to go into is some of these indicators that we cover each week, just to give you a barometer on where we are. Here's the put-call ratio, 10-day put-call ratio at record levels. You don't want to be a seller when everyone's buying insurance exactly at the bottom, which happens every single time, and it happened this time as well. We'll see if this is a holding bottom, but I think that would be maximum pain for a lot of people if we pushed higher and massively higher in coming weeks. So let's see how that works out. Same thing with the NASDAQ EMA. Again, you buy down at these levels, you get paid historically. Everything points to NASDAQ being oversold, down 33% year to date. If you can't find bargains there, find another business. You don't want to be buying things wholesale because some things are cash generative and some are not. And I think those things that are not cash generative are not going to be good investments. Same thing with REITs. We talked last year, the last shall be first. last week rather. REITs and emerging markets were the worst for the year, although now I think the China stocks are certainly outperforming the NASDAQ, but may even be outperforming the S&P year to date. What a difference a couple of months makes. But I think REITs, there will be some opportunity in 2023. You talk real estate to anyone now, there's pessimism. I think that it's going to get more pessimistic, but we'll be looking there probably in coming weeks and months. NASDAQ again, everything points to NASDAQ is where you're going to find the value. PMO buy all is down here. We'll see if we can get this thing to ramp back up to 100. Okay, same thing with PMO by SPX. We've covered these many times. I just wanted to give you a visual of where we are and what's there to be bought. Here's the CPC, not on a 10-day moving average. Again, higher than pandemic lows yesterday, and everyone was panicking. I had people, DMing me, "Oh, Disney just made a marginal new low." Oh, because they don't know what they own. They're traders. They're emotional people. And I mean, at the end of the day, if you don't know what you own, just dump it in the hole, and I'll be the type of person that's buying from you. And then today, of course, it was up 3% after everyone was panicking. Or 2.5. I don't know. I don't even know where it closed. I don't look at this stuff. When you know what you own, you're not worried about it. You think 1, 2, 3 years out. You know it's a double, and you go from there. McClellan Oscillator, same thing. So, you just go skew. We talked about this. There's nothing to ensure. The house already burned down. VIX is trending down. So all the things are in place. Been a bumpy ride. By the way, want to thank existing clients. Choppy year. Now everything is on the upturn with China bottoming finally in October, with biotech bottoming in May, up 26%. The China stocks all up 50%. And Cooper Standard, our top 3 position, Cooper Standard is now up 56% in a down market. So that's pretty exciting. And new people that just came on board, congratulations to you. You are set up for a monster 2023 along with my existing clients. I'm very, very excited as we turn the calendar. And we're already seeing signs of that, happening already with our core positions. Okay, this is a ratio sector charts. This is real estate to SPX. So, most people buy on, breakouts, and that's, it's not our thing. We like to buy when things are out of favor. Last time REITs were this favorable would have been 2018, then early 2021, and they're now again. So we think REITs are going to be an opportunity. They're bottoming relative to the S&P 500. KWeb, that's the China internet, you can see put in that double bottom in October and is now starting to rip higher. This is like an ideal double bottom. You just see them over and over and over. So we love the China internet stocks. Bonds relative to S&P look like they're bottoming a little bit here. Biotech, okay, great day today. Again, they had this huge drawdown, even more pronounced than 2016 tightening cycle. And now they are just starting to dramatically outperform since May. As we've said, it's been in this sideways grind for 3 months. Like, I've never seen a chart. This is the relative ratio, but if you look at like the XBI, it's literally been in this narrow sideways grind like every single day for 2 months. It's unbelievable. But, that's how you get these bottoming processes. You go up, you check back, throw everyone out. And this move here, in the XBI was up 100+%, and I think we're going to see similar stuff coming forward. Here's materials, but everyone's pitching on TV, buy materials. We think that move has already happened. Here's communication services. You can't give them away. You can just Google XLC and see the top holdings and find a few you like. Energy, everyone's pitching that's going to be the big thing. I think energy will work for long term. It needs to come down a lot before I would reload on that. We made our money with that 2020 and 2021 and early 2022, maybe a little too early 2022, but bulls make money, bears make money, pigs get slaughtered. Financials, kind of neutral land, but you look at Bank of America, Wells down at these levels. I don't like them with the inverted yield curve. We made all our money again 2020 to 2021, bought at 25.01, sold in the high 50s, rinse and repeat. It's down at 40. I mean, maybe we would nibble, but there's just too much other stuff to do. Industrials, everyone's pitching that. Again, it's probably the best days are in the rearview mirror, and that's why everyone's excited about it. Staples, same thing. All the defensives are up. Everyone's pitching those. Utilities. There are a couple utilities I still like, though. Healthcare, no. This is different than biotech, by the way, which we covered biotech. This is defensive healthcare. Think Cigna, think UNH. I think that trade is long in the tooth. Everyone's pitching it on TV. That gives me greater confirmation. Discretionary, I think that's where you want to look. Everyone says the consumer's dead. They are not. You saw the MasterCard spending up 7.6%. This is from Seth Golden, does great work. He's talking about the weeks. He posts this chart from Bespoke Investment Group, consecutive weeks with a negative AAII bull-bear spread. And you can see that in all these instances, this has been an extreme pronounced. I mean, we weren't even close to that during the great financial crisis. So the last time we saw anything like this was after the pandemic, when no one was believing the rally in summer and fall, and it just kept going and going and going. And the other time was the S&L crisis during the 1990s. So we like the risk reward here. Also from Seth, looking at the last 7 bear markets since the 1987 crash, we have seen the market bounce back an average 43.6% over 12 months. So it just shows, 33% drawdown during COVID, 20% during the trade war in 2018. This is the S&P, which is what we just did, by the way, 20%. This is 25 or maybe 28% peak to trough. Great financial crisis was 56, tech bubble, Asian money crisis 98, Gulf War 1990, et cetera, et cetera, et cetera. So the rebounds are huge. The same thing. Historically, when the 60-40 portfolio has fallen 20%, good things happen the following next 2 years. And you can see this is from Ned Davis, he's posting. And that was 73, 74. That if 74, it fell this much. The next 2 years were up 15, it looks like 17 and 15% consecutive back to back. Then it happened in 30-31. Next 2 years were up 17.5 and 35% back to back. So that's it shows the risk reward. MasterCard spending, we saw total retail up 7.6%. In-store was 6.8, and online was still up 10.6. So people are doing more online, not only in the U.S., i.e. a la Amazon, which we've been talking about, and in China, a la Alibaba. So the big thing was restaurants were up 15.1%. People are getting out and about. Electronics, they loaded up during COVID. Jewelry, I guess they loaded up during COVID. Yeah, there was a watch craze during COVID. Those are down. And all the crypto people had to sell back their Rolexes. And then apparel, by the way, maybe a good year to buy Lambos if you're into that thing. I'd be more interested in a McLaren. I don't know how many crypto guys bought those, but we'll see what 2023 brings. Apparel up 4.4%, so people getting back out need that. Here's why a bull market may have already started, even though it doesn't feel like it, according to eToro's investment analyst. This is Callie Cox, I believe. Yes. If the economy avoids a recession, as possible, stocks have already bottomed out and will tick higher in 2023. Typically, new bulls don't actually feel like bulls, but it's costly if you miss the beginning of one. And the point that she makes that I thought was interesting, a bull market starts at the lowest point of a bear and is confirmed when an index reaches a new 52-week high. So by the time everyone says the coast is clear and we're in a new bull market, because they're going to call every rally a bear market bounce, and they're going to draw that slanted line down that you see from all the people on Twitter. And by the time they realize that it's not a bear market rally and we're at new highs, they've missed, 40, 50, well, let's see, 3,800 to 4,800. So yeah, they'll have missed 30 something, 35%, and you can't, you miss those, you're toast. So you can never recover from that. So Here's an article that one of our listeners sent. On Micron, when everyone was negative on this sector after their earnings. It said the auto market for chips is soaring, and it goes on. This is called the technologyletter.com, and it goes through all the deals. This is stuff we've been saying for months, that the allocation was going to go to electronics shortage, into auto glut. Now they're shipping the chips like crazy. They're shipping the cars, and that's going to increase the numbers for Cooper Standard, and we're seeing it in the last few days in the stock. So that's exciting to see. Just the beginning in our view. Manna from Heaven, inflation, a world that is not ending. A top strategist offer ideas on investing for a brighter future. His basic thesis is the manna from heaven is this perfect situation where inflation is going to average 3 to 5% per year, which is what we've been saying for 8 months, that they have to run inflation above trend, but they have to keep pretending that they want to get it to 2%. The reason they have to run inflation above trend is because you've got 120% debt to GDP, and they can't afford the interest service payments. This is not a Volcker scenario where he had debt to GDP at 31% in 1980. It's a debt to GDP of 120%. So the more they tighten, the more inflationary it is, because they're not collecting enough tax money to service the new interest payments. And the only way they're going to be able to service them is to print money from the Fed, which will be far more inflationary than just actually stop tightening, pause, leave rates elevated for some time, and let inflation run 3 to 5% while you continue to talk hawkish, so you keep inflation expectations down. This was interesting. This is from Ken Fisher. There's an article in the New York Post, why 2023 will be like 1967 summer of love for the stock market. I don't know if he listens to our video cast, but we put out this analog literally like 8 weeks ago, about 1966 and 1967, and possibly following that analog. So we'll see if it plays out. He put a little more color in terms of what was going on in the world, etc. But this is something that no one can believe right now, and no one would buy into, and that's exactly when something like this actually happens. This would be maximum effery for the way people are positioned right now, and everyone would keep calling these bear market bounces. We're going to go take out the lows, and then you get up here, and they all get completely effed. They all jump in here, and then they get shaken out. They get no gains for the next, half a year or whatever. So while everyone's calling for, I love it. It's now 100. First off, the triple break putt was the first thing. We were supposed to go up into year end, then down into March. That would be the bottom at 3,200, and then we're going to have a great back half. And instead, we went down into year end. We probably have a good Q1 when no one's expecting it or positioned for it, and then when everyone thinks it's going to be the back half, they'll all be jumping in because they missed it, and then we'll get probably more muted returns. And that also is consistent with the presidential cycle. The two best quarters of the 4-year cycle are actually coming up after the worst year, which is the second year of the 4-year presidential cycle, which was 2022, is followed by the best year of the presidential cycle, 2023, and the first 2 quarters of that third year are the best. So it could be set up for what we were talking about for 8 weeks ago, when everyone was glum in October 13th, and we were saying, look, hang tight here. History doesn't repeat, but it does rhyme. And we put out this one, and I think it was like one from the 50s. You can go back and check the video cast, but it's on my other desktop. But so that's that. So great article by Ken Fisher at my favorite paper, which is the New York Post. So you could actually, I posted it in what I'm reading today, I think over the weekend, but it's Christmas Day, December 25th. Why 2023 will be like 1967 summer of love for the stock market, and that's at the New York Post, so you can just search that title. Healthcare deal making set to surge in 2023. That's what we're positioned for. But what they're talking about is the deal flow that we referenced in last week's VideoCast podcast with all the biotech deals that are happening. Why? Because all of the big pharmas have tons of cash. They've got patent cliffs coming due, and they're going to have to buy that growth. And with the valuations where they are for biotech, game on, baby. as well as drug approvals game on because COVID's a rearview mirror and they're refocused on it. This spurred some of the rally today, which is the continuing jobless claims, which we focus on every week, hit 11-month highs. So now the Fed has cover to maybe pause or at least do one last 25 basis points and being done. Because these jobless claims are really starting to accelerate, and hopefully they'll get ahead of it and keep rates elevated, but stop hiking them. Jeremy Siegel says real inflationary challenges are over, predicts 15 to 20% rally for U.S. stocks in the first half of 2023. We agree. Moving on. This is the China mobility tracker from Brendan Ahern. He runs the KWEB ETF, puts out some good stuff on China last night every day. And it just shows in Chengdu, it's basically all the way back after they've reopened. What's the yellow one? Beijing is almost all the way back. Beijing is the highest it's been since November 14th. Some of these other are just getting started. So this is all going to go back to highs, and everyone's going to have herd immunity, and we're off to the races. So that's good to see. BioNTech mRNA vaccine approved in Hong Kong last week. That's really, really good. All the rich people are going over and getting it for their friends. And sooner or later, it's going to just wind up being in China, and then it's over. China estimates COVID surge is infecting 37 million people a day, which means so every 3 days they get 100 million. So 14 times 3 in about a month and a half, everyone in the country will have had that if that persists, and that's herd immunity. So they've been doing this for about 2 weeks, so another month, and everyone will have had it, which is pretty good. China tech stocks are winning back investors after an awful year. Opinion follows trends. They're up, some 50, 60%. And here's Alibaba forward earning estimates are rebounding as well. They troughed in May, and they've been rallying ever since. So the fundamentals are actually following the price, which is good. China estimates 250 million people have caught COVID in 20 days. So that's about right, to get to where we need to be by mid-January. China stocks rise as top brokerages predict swift economic recovery from COVID impact. So we'll just get through this. Beijing to distribute Pfizer antiviral drug as COVID wave strains healthcare system. I guess the lemons and peaches weren't working. So now they've got to get some serious medicine to deal with it properly and move on to the next thing. China's economy begins to reopen after 3 years of COVID isolation. This is a big deal, and I covered it on the TheStreet.com. Analysts are dramatically underestimating. This country is the second largest economy in the world. It's been closed for basically, over 2 years, called 2-3 years. And the West has been carrying the water through stimulus, through fiscal monetary policy, staying open, doing the vaccinations, etc. And we have no idea the impact that 5% GDP growth, the government set their target for 2023 at 5%, and they're doing the stimulus. The difference is the stimulus is going to work this time because people are free to benefit from it and to circulate it and increase the velocity of money. And the amount that's going to do to carry S&P earnings, to carry Europe, is going to be staggering. And I think it's going to be quick because these people have a ton of savings. They've been locked up for 2 years, and I think it's going to be off the rails in a good way. And I think that's going to help S&P earnings. And I think that's the surprise in 2023 that no one's positioned for except for our clients and a few other smart managers. Hong Kong ends, smart and brave, by the way, I would say. Hong Kong ends last COVID curbs in bid to revive finance hub. Okay, so we know about all this. China's elite give Paxlovid to friends as demand soars for the COVID drug. Chinese are snapping up flights abroad as Beijing drops more travel restrictions. Hong Kong's Hang Seng Index jumps to 4-month high. I mean, what a difference a couple of months makes. Hong Kong scraps vaccine pass, COVID test for travelers. Tencent gets extend 3-month rally after China approves new games. This was the last bit of the crackdown that hadn't been unwound. So we saw that. China revenge travel will lift tourism in 2023. China's megacity Chongqing joins Dongguan. Fujian in easing home buying restrictions to revive pillar of the economy. So the game is back on. Shanghai's economy will expand 6% in 2023 amid wave of foreign investment in post-COVID era, economist predicts. So 6%, I mean, that would be unbelievable. China vows appropriate fiscal expansion to aid economic growth. That's from today. In 2023, a proactive fiscal policy should be strengthened to improve its effectiveness and play a more direct and effective role. Citing minutes from a nationwide virtual meeting of finance officials chaired by Minister Liu Kun. On to the article of the week. Damn Straight stock market and sentiment results. Damn Straight is a song by American country singer Scott McCreery. It was released on October 18th, 2021. The song is a tribute to country music legend George Strait. I think as we approach the end of the year, many investors in any risk assets, whether it's stocks or bonds, can relate to his lyrics when he said, "Damn straight, you're killing me, man. You know I've always been your biggest fan." And I think that's how people are relating to risk assets right now. And when that gets that despondent, if you're not in buying, find another business. But there's just so much amazing stuff on sale right now. The key is, getting more resources to take advantage of all of it. I mean, it's mind-boggling some of the markdowns in these businesses that can be had at these levels. Even if all the bears are right and you get your triple break putt and you go down to 3,200, and it's like it really doesn't matter based on where you can buy some of these businesses today is mind-boggling. So or you could have bought them, as we were in the hole. For the Chinese stocks, the hole was in October. For the biotech stocks, the hole was in May. And for Cooper Standard was also in late May, early June. So the good news is it's always darkest before dawn. And as we covered last week, our three largest positions are showing some nice buoyancy. BABA's up over 50% off the lows. Cooper Standard's now up 56%. It's up pretty big in the last 2 days. From our inception, our basis is around 550. And then biotech's up, it's probably up closer to 30% off the May lows. It had a big day today. While the general market is weak, we're finding some calm in the storm of late. On Wednesday, I joined Kelly O'Grady on Fox Business, covered that. Thanks again to Kat Myers and Liz Clayman for having me on. You can find our full thesis. So we went into Cooper Standard with Kelly, and you can find our full thesis on Cooper Standard by clicking here. Last week, we went into it comprehensively once again. You can also go back to May, but it's basically a reiteration of what we wrote initially in May when we initiated at 550. So yesterday, I also joined J.D. Durkin on the street to discuss General 2023. Now, here's some notes ahead of that segment. So first off, back-to-back losing years for stocks are very rare. That happens less than 10% of the time. It only happened twice post-World War II, which was 73-74 and 2001 to 2003, and 2 times pre-war. But on any given negative year, the next year is up on average by 12.6%, 13.5% post-World War II, which is above the long-term average. We covered the 1982 thing when Volcker finally shifted from keep at it to May shift tactics, recovered all these losses in 4 months. And this would be similar to that 1967 analog where everyone doesn't believe it, and then it gets up here, they all start buying it, and you get no returns for like 6, 7, 8 months. After they're all sucked in, they get shaken out, and that's when you move back into the second half of the 20-year secular rally that we're halfway through, based on demographics, which we've covered historically many, many times. Average 12-month return since 1954 after the Fed pauses is 14%. That's happened 13 times. So if we get a pause in February, you could see that positive things happening thereafter. Earnings coming down. We covered this before. All the bears saying earnings have to come down lower. Number one, they've been wrong. They've stayed the same for 2 months now, 231. But let's say they're right. The stock market bottoms 6 to 12 months before earnings do every single time. So by the time, if you wait for the robins to sing, it's already spring. as Buffett likes to say, and I think Callie Cox put it well. By the time they say that it wasn't a bear market rally, you're at new highs. So good luck with that. And consensus top-down expectations are frequently wrong. Coming into this year, while we were saying we're going to get an 8 to 12% correction in the first quarter, we were wrong. It was double that. But most analysts said we were going to 52.61. 52.64 was consensus. We wound up at 38.21, 3,800 or wherever we are, 3,900 now. And now they're all saying we're only going to be at 4,000 by the end of next year. And my guess is they'll be just as wrong about that. And we'll probably be, in the high 4,000s and no one's positioned for that. So we are, and we're going to take advantage. So negative December bad omen. So 4 times since World War II, the Dow's been down the S&P's been down greater than 4% in the month of December. The average 12-month gain is the average gain 12 months later is 20% on average. You can see the 4 instances. Small sample, but worth noting. The Santa Claus rally, there's still chance that goes till the second trading session of the new year. So if we get some follow through on today, we could very well have a Santa rally, which bodes well for January. If you have a positive January, then on average, if you have a positive return in January, the average return for the year was 17.6, which is well above average since 1950. That has 84.5% accuracy. Presidential cycle we covered. We're now moving from the worst year of the 4 years to the best year of the 4 years and the best 2 quarters of the 4 years. So we'll see if that follows through. Everyone's saying valuations are still too high because rates are high, but Fed funds rate average has never been this low pre-financial crisis. That's here. It's always been higher. So even in the mania valuations of 99 and from 95 to 99, the Fed funds rate was 6.5%. We're at 4.25. So it's all perspective. You gotta take a look at history before you draw these definitive conclusions. Just looking at your recency bias when money was free. Inflation was peaked in June. Average 12-month forward return since 1950 after inflation peaks is 13.21%. And investment ideas we've talked about. Emerging markets are now trading at 2007 prices. Historically, that trades opposite the U.S. dollar. And just like you saw, every time the dollar peaked and started to weaken, monster rallies 480% from 2002 to 2007, 189% from 2009 to 2011, 96% from 2016 to 2018, and 97% from 20 to 21. You see how this chart here from Charlie Bilello, how it moves in cycles when emerging markets dramatically outperforms the S&P 500, like from 1988 to 1994. And then from 1994 to 99, the U.S. dramatically outperformed. Then from 99 to 2010, emerging markets dramatically outperformed. Note the weakening dollar during that period. And then again and now here we are back again, 2010 to 2022. S&P outperformed, and we're back down to levels where we could be ahead of one of the biggest rallies yet, in our view. We think emerging markets will be the best trade over the next few years. China's the biggest weight of that, close to 40%. We've covered all the factors there. We also like Amazon. Amazon, you can buy at 2018 levels. They've tripled their revenues since that time period. They've tripled their AWS revenues. They've tripled their ad revenues. They've doubled their e-commerce revenues, and it's trading at the same price. Oh, and by the way, their Prime members are up from 100 million to 163 million. You can't give it away. So it's just a function of what happened with rates and people deleveraging and coming off margin. But it's a great business, and that one will probably be a double over the next 5 years. Not our best idea, but certainly something worth looking at. There are a lot of easy double setups. Our core positions all have multi-bagger upside, not double upside, and then the rest of the portfolio, which is proprietary to our clients, have a lot of these other opportunities in them. So here's Alibaba earnings. There's public bullish percentage starting to tick up, 26% this week, up from 20. So it's still barely coming off the mat. Fear is still high, all the conditions perfect for some follow through in this rally. We'll see how that goes in coming sessions. Here's the earnings that I wanted to cover with for calendar year 2023. Consumer discretionary is going to be the highest earnings growth. No one wants to buy any of them. You can just Google XLY top holdings and start to do your work on some of the best opportunities. They're going to grow earnings at 5.8. So everyone's saying stay away from consumer discretionary. Everyone's saying get into energy. Well, energy earnings are going to be negative 13% next year. Materials are going to be negative 8%. Healthcare is going to be negative 3%. They had good earnings this year. Everyone's chasing them into the hole, and they're going to be buried. So industrials are going to be pretty good earnings. Financials pretty good. Communication services. I think communication services and consumers discretionary are going to be solid, and then some pockets of infotech and some pockets of REITs. So that's the story there. And then we'll go to the economic data. The big thing today, which I want to show you, was the continuing claims shot up to 1.7 million. That gives the Fed cover. They're getting the job weakness that they wanted. Unfortunately, they won't have the non-farm payrolls before the February meeting from January. January is when all the layoffs are going to happen. I don't think you're going to see it in the December report. But they will see these weekly initial claims, 4 of them before the Fed meeting, and initial jobless claims are 225,000, up from 216,000. So they're all ticking up, and those were the big numbers. Okay, so if you ask me anything questions before we wrap up here and let everyone get on to their Happy New Year. Okay, would appreciate your comments on D-Local from Nicholas Spritzer. So this is the stock, DLO. You can see here it's, it was a $73 stock. It's now a $15 stock. And then you pull up the, I don't know why this is so slow. I guess a lot of people are on it. Okay, so I can start to talk while this thing loads. There we go. I don't even know what. I don't even know what the passcode is. All right. So, all right, let's go here. Ticker is DLO. All right. Now, all right, basically, all right, I took a quick look at this before the call, and what you're seeing with this stock, it's a payment processing stock based in Uruguay that does business all over the world, similar to Yalla, based in Dubai and does a lot of business in China. And the good news is the economic data is growing in leaps and bounds, but the problem is there's only 3 years of data, and so while it's going up dramatically and while all the numbers look great and the stock is beaten down, number one, I don't know if you have a defensible moat with payments, and two, the gross margins have come down. I think it was from 65% to 48% in 3 years. And there's only 3 years of data. And if you've watched the podcast, videocast long enough, you'll know I don't touch businesses that don't have multiple years of data. I want to see how management has performed through different cycles. Okay, so you can see here, look, this is a tiny business, but the revenues have gone from 55 million to 376, so it's growing like a weed. But then the gross margins have come down from 65% down to 49%. So it's, maybe some of that has to do with COVID, but for such a new business, it's like, what is the moat? You've got Square, you've got PayPal, you've got all these different things. So I think, you could certainly take a punt on this. Their return on capital is halved in the last 4 years. It's still very high. Same with return on equity. Gross margins coming down, but they're still phenomenal. With these type of situations, just like Yalla, they're tiny, fast-growing businesses, high risk, high reward. Not a long enough track record of proven operations through cycles. But with something like that, it's you take a flyer. Maybe it's a 1% position. It's not for me, but here it is. Operates payments platform in the U.S., Europe, China, and internationally. Payment platform enables merchants to get paid and make payments online. Like, who doesn't do that? Every bank does it. Maybe there's something special about this, like Square or PayPal, that kind of got a little bit of an edge, and maybe it was a first mover in some of these markets. So you'd have to do more stuff, but it serves as commerce, streaming, ride-hailing, financial services, advertising, software as a service, e-learning, on-demand. It was founded in 2016 and is headquartered in Montevideo, Uruguay. So you'd have to go through every conference call and you'd have to understand it. But for me, I'd just rather buy a high-quality business that's marked down, make a double or triple in a couple of years and move on versus taking this level of risk. Maybe you get a multi-bagger here. But you're kind of gambling. I mean, you've only got 3 years of track record. You don't know if the business has a moat or if they're going to be just hundreds of entrants grinding down the gross margins. So I'd say, I think the framework of your analysis is correct. And maybe you take a flyer on it because it could work, but it's better odds than gambling because the numbers are decent, but it's high risk, high reward. I mean, that's all there is to it, and that's not our bailiwick. Saeed, do you have portfolio company suggestions for long-term holds, or do you just give spread suggestions? I guess he's referring to the trade service. Trade service is shorter-term spreads. The long-term holds, we cover some on the podcast videocast, and our best stuff is obviously reserved for our clients. Rob Rutshow says, have you currency hedged your BABA position? If so, how? If not, why not? CNY depreciation seems almost a lock. Thanks, keep up the good work. No, because the cost to hedge it doesn't make sense on that trade, because the cost to hedge will wipe out some of what you think you're gaining, and then you have to be right about your estimate. What we know is the dollar's going down or the dollar stabilized. Emerging markets will get bid, and the key is not whether the yuan, vacillates a small percentage. The key is going to be huge institutional flows coming back into the country now that it's safe once again, and that's going to overwhelm any currency movement. And hedging you'd probably, by the time you're done with the costs and the volatility, it paid you nothing to hedge, and you might have actually lost some upside. So no, we wouldn't hedge that type of position. Nicholas Spritzer, oh, he already said that. D-Local. Paul Falcone. Oh, this was one from a few weeks ago. Do you factor dividends into any of your analysis? If you look at a company like VFC, it's down big over the last 3 years, and the dividend yield is at a point where, historically speaking, it's been a good time to buy. However, if they can't make the payout, it could substantially impact the stock price. Just curious how you think about dividends. I generally don't. I mean, unless VFC has a history of increasing the dividend for 10 or 20 years, it doesn't really matter. What you'd want to do is a cash flow analysis. I think VFC will probably wind up being a decent trade over the next 3 years as a business. The dividends, I mean, if they're like a dividend aristocrat and they constantly do that, and I know if I can buy it with a high yield over time, that dividend's going to grow. And like, Buffett buying Coca-Cola in 1989, in 20 years, that dividend yield can be 50% off my basis because the dividend keeps compounding. That would be interesting. But VF Corp, I don't think is that high quality of a business where you're going to see that massive dividend increase consistently and predictably over years. But I think it is a beaten down enough business, again, in consumer discretionary, that it may be worth a hard look and doing some real work on it. Eric Haney, given the recent news and earnings from Cooper Standard in the past months, are you concerned at all that there's been no insider purchasing? There can't be insider purchasing when there are negotiations to do the deal. So I would expect to see no insider purchasing until after January 18th. And my guess is if the stock's moved up quite a bit, they may not be purchasers at that high levels, but that would be the earliest that they're able to purchase. Okay, and we covered Rob. So with that said, I really want to thank everyone for an incredible year, and wishing everyone the best of everything, health, happiness, prosperity in 2023. Going to be a great one. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now. Happy New Year.